Hi team, welcome to another video for tutoring. So today we're going to be going over chapter 4, which is types of policies. This one is going to be a huge part in your test. Your chapter, how it's laid out, gives you all of the information that you need for these types of policies and what you need to know for your test. So let's get started. I'm going to go ahead and share my screen. Alrighty, perfect. So with insurance, right, we need to keep in mind that we are getting our insurance license, so we need to learn about all types of insurance and not just the type of insurance that we personally sell. Okay, so this is going to be important for us to really get a hold of. And when we become agents, it's going to be important for us to kind of understand, well, not kind of, it's going to be important for us to understand these policies, but we're going to learn about them once we're licensed in a different way. So what we're going to be learning about today for types of policies is going to kind of be objective, meaning we're not going to like expose any types of insurances, even though sometimes, insurances work a little worse than others. So what we're going to do here is I'm going to give you the layout, the basic information that you need for each type of policy. There's also pictures in here that are going to do a lot of good. So if you're taking notes on paper, which I personally think you should, it's going to be important for you to definitely write down, like jot down a picture of these insurances. And write down like the main things about them, just to kind of grasp the concept, because there's going to be keywords for each of these. I normally draw them out, but with the way that UCANPASS is set up now, I can't highlight and I can't draw on the screen while I'm sharing it. So we're going to go through it as best as we can, and I'm going to give you the main information that you're going to need for each type of insurance. So first thing I want to go over is going to be the keywords, right? We need to learn the terminology before we get into the chapter. So first one is attained age. Okay, attained age, this is the insured person, right? The person being insured, their age at the time that the policy is renewed or replaced. Okay, so let's just say that I'm a client, right? And I have a 10-year term. I was 50 when I purchased it. At the end of my term, I'm now 60, and my attained age when I renew, right, is going to be 60 years old. That's what the attained age is. Okay, it's the age of the person insured at the time of policy renewal or replacement. All right, next is deferred. Okay, you're going to hear this word a lot, but deferred means to push out, to postpone, to hold back. Okay, so the word deferred means withheld or postponed until a specific time or event in the future. Now, I want you to think of payments, right? I don't know about you guys, but let's just say you have a payment coming in and you just don't have the funds right now. So you get a hold of the company and you say, hey, can I pay it on Thursday? That's deferring it, right? Let's push it out. Let's push it back. Okay, so deferred means withheld or postponed until a specific date or time event in the future, okay? Lapse. We already went over lapsed, but lapse and cancellation are two different things. So lapse means that the policy is terminated due to non-payment of premium, meaning this person did not pay for their life insurance policy premium, and therefore it is going to terminate because of non-payment. That is lapse. If you're canceling, that means you physically have to cancel that policy. You have to call, reach out to the company, let them know that you do not want this policy any longer, but it's not because you haven't paid, it's because you want to cancel. Okay? Level premium. So we're going to be going over a lot of different level premium policies, okay? Level premium means that the premium does not go up, does not go down, does not move around. It's just going to stay the same for the entire duration of the policy, okay? Now, there are several different ways to pay premiums. There are different modes to the premiums. There's lots of different things that go into that, but we're going to get into it when it gets to that type of policy, okay? A good example of a fixed, a level premium, right? Or a fixed premium would be a term policy, right? Unless it's annual renewable. Think of level term, right? In that case, the word level is talking about the death benefit, right? But level is for the death benefit, level is for the premium. So it can get a little bit confusing. Just know level premium means that we're paying the same premium across the board. Okay. All right. We have non-forfeiture values. Okay. It's just a big word for what's going to happen to the money if I cancel. Okay, so non-forfeiture values, these are benefits in a life insurance policy that the policy owner cannot lose even if the policy is surrendered or lapses. Okay, this is for whole life, universal life policies. Non-forfeiture values are basically, let's think of the guaranteed cash value, right? Or whatever's in your policy. Even if you surrender, you're guaranteed a certain amount if you cancel at a certain time. And so we'll be going over that as well. Keep in mind that all of those things change, but we do need to know them for our test. Policy maturity. Okay, when a policy matures, it means that that is the time when the face value is paid out, meaning the death benefit is paid out. If a policy matures, that means that it's closing out, it's done, it was paid out, something must have happened in order for this to close out. Okay. Securities, we're going to learn a lot about securities, who needs their licenses for securities in order to do certain life insurance exchanges, what kind of what's the word that I'm thinking of? What kind of registrations? There we go. What kind of registrations do securities agents need, right? If you want to be a broker, like my husband, like the Diaz's, they have their securities license and more. Okay, so securities licenses, they have certain guidelines. They also go hand in hand with certain types of policies. And so we're going to be going over that. Okay. All right, next. So the first type of insurance that we're going to be going over is term life insurance. Term life insurance is what we mainly work with, at least us personally, right? So we need to be able to understand what term life insurance is, and there are different types of term life insurance. Okay, there are several types of term. And so we need to go over what those types are, and then what term is mostly used for in general, okay? So first thing, term life insurance is temporary protection. Okay, temporary protection. Whole life is whole life policy, like it goes your whole life, right? So it's a lifetime kind of a policy. Term is for a certain period of time. Think of school, right? A term is however many months. So term policies are going to be however many years, whatever your policy states, okay? So for your test, please know that term insurance is temporary protection because it only provides coverage for a specific period of time, okay? This is also known as pure life insurance, okay? They call it this because there is no cash value included. We do that separate in our company, right? So term life insurance is pure life insurance, okay? Because it's only life insurance and it only covers for that person's life for that period of time, okay? Keep in mind, please, over and over that this is temporary protection, okay? Term insurance provides what's known as pure death protection, okay? Meaning there are no living benefits. Okay, it's pure life insurance, like just death protection. There's no cash value involved, okay? All right. There are three basic terms types of term. Okay, there are level term, right? There's increasing term, decreasing term, and then there is a fourth, but this one isn't really term insurance. It's called annual renewable term. And so we're going to be going over all four of those here. These three basic types of term coverage available, right, are based on how the face amount, the death benefit changes. Okay, so when we hear level, right, with these term policies, we are not talking about the premium. Okay, I need you to be super clear on that because you will get questions on your test that try to trip you up about it. Okay, so level term is talking about the death benefit. Okay, $300,000. Let's just say the death benefit is $300,000. In level term, it is going to stay $300,000 the entire duration of that term. It is not going to go up. It is not going to go down. The death benefit. Okay. Term insurance also has a level premium. Okay. So two level things in level term. Okay. Let's just know that there's two different things. All term has level premiums except for annual renewable term. Okay, so I just want you to know that when you see increasing term, it's talking about the death benefit. So the death benefit is going to increase slowly over the years. It's going to go 300,000, 310, 320, 350, 380, right? It's going to keep going up. Decreasing term, 300, 280, 270, 260, 200, right? Like it's going to go down. The death benefit is what is going down, not the premium, okay? All right. Like I said, regardless of the type of term insurance purchase, premium for term policies is level, meaning we are always going to pay the same premium, nothing more, nothing less. Even though the death benefit might be going up or down, the premium is still the same. Okay. So number one is level term. This is what we work with here. But level term insurance works like this. We're going to see boxes, right? Here is the beginning of the term. Let's just say it's 30 years. Here we are. Here's the end of the term. Notice that our premium is not going up, is not going down. It is staying the same the entire time. Here we are at the death benefit. The death benefit is going level the entire time. It's not going up, it's not going down. That is how level term works, okay? Level term insurance is the most common type of life insurance, of term insurance, okay? This is temporary protection. The word level in level term refers to the death benefit that does not change throughout the duration of the life policy, okay? Please watch these videos too in your own time if you need like some more clarification because they have a lot of really helpful videos here. All right. Annual renewable term, right? So annual renewable term is what I would call more like whole life. Okay, this is the basis of where whole life started. Okay, annual renewable term or ART is the purest form of life insurance. Why? Because as we grow older, we are strictly paying the cost of insurance. Okay, so the death benefit remains level, meaning it's not going up, it's not going down, right? It's level, the death benefit, but our premiums are going to get more and more expensive the older and older we are. Okay, every year that the policy goes on, it will tack up just a little and just a little and just a little. Okay, why does this happen? Because as we grow older, we have more risk of passing away, right? So the premium is only increasing because As we grow older, our risk is higher and higher. Therefore, our cost of insurance is higher and higher and higher. Okay, so annual renewable term, the only thing that's different, right, than whole life is that it's temporary protection, okay, and it has no cash value. It's going to be for a specific period of time. The death benefit is going to remain level, and every year our premiums are going to increase based off of the cost of insurance for this person. Okay, so it will increase little by little, the longer our policy goes. Okay. All right. Next, we have decreasing term. So really quick, decreasing term, reminder, the death benefit is what is decreasing. See right here where it says face amount, death benefit. See how it's going down. Okay. The premium remains level. We are not going to pay more or less depending on how long our policy is. The premium will remain the same. And then it's for a term, a certain period of time. And I know you guys might be thinking, Carly, why would we be paying the same amount of premium for less coverage? Makes no sense, right? That's true. And that's why we don't see these very often or ever, but we need to learn them for our test. So decreasing term is for credit. Okay. This is for insurance with the bank, right? For loans. That's what I want you to think of. Okay. So how it works is decreasing term policies, right? They have a level premium and a death benefit that decreases every year over the duration of the policy term. Okay. This is normally used for the payment of mortgage or debts. Okay. For if the insured person dies prematurely. Here's the example. So let's just say I just purchased a new home. I live in California, guys. I actually live in LA. So imagine homes are like $500,000, between $500,000 and $1 million just for a regular home. Okay. So what we're going to do is we're going to go to the bank and we're going to ask for a loan, right? Well, what the bank wants is to make sure that we can repay this loan, and if we pass away, that they will not lose out on their investment. Okay, so what the bank is going to do is have you pull out a life insurance policy for that $500,000, that $1 million that the home is worth. Now, every year we pay our mortgage, or every month we pay our mortgage, right? It chips away at what is owed every time we pay. So in theory, that amount of the house is decreasing, right? The amount that we owe should be going down the more that we pay payments. This is why decreasing term is decreasing. Okay. Every year it gets closer and closer and closer to zero. This is what we want, right? Because if we pass away, some odd here, right? This will allow our family to pay off the bank and keep the home. Okay. In real life, do we see these policies? No, I have never. I've never. But in theory, this is how they work. Okay. So we would have this kind of policy to cover mortgage, to cover debt, to cover credit. Okay. That is what these are for. Remember that face amount is decreasing. Okay. At the end of the policy term, it will be zero. Okay. And remember that our premium is always going to be level. Next is increasing term. Increasing term works differently. It's the same as decreasing term, but it's going the opposite way, right? It's going to be going up. Our death benefit is going to be increasing. Our premium remains level throughout the period of this term. Okay. Now, with increasing term, there are a couple of riders that go along with it, but this is why people get increasing term. Let's just say today right? Or let's just say 30 years ago, right? Like when I was younger, my mom purchased insurance, right? To pay off our house and pay off our debts and pay off all this stuff. God forbid something were to happen. Can we all agree that $300,000 doesn't have the same purchasing power as it does nowadays because of inflation, right? Because of cost of time value of money, right? So increasing term, the death benefit is going to be rising because people are afraid that their money, their 300,000 is not going to have the same kick that it needs to later on in life. Okay, it's not going to have the same purchasing power. So what they do is they purchase increasing term. Okay, it's a level premium, but every year this is going to increase and follow the inflation. Okay, it's going to follow inflation. This gives us a hedge against that. Okay, so increasing term features a level premium that's death benefit increases every year over the duration of the policy. The amount of the increase in this death benefit is usually expressed as a specific amount or a percentage of the original amount. Okay, increasing term is often used by insurance companies to fund certain riders that provide a refund of premium or a gradual increase in total coverage, such as the cost of living or return of premium riders. Okay, this type of policy would be ideal to handle inflation and increasing cost of living. It is also often added to another policy as a rider, such as the return of premium riders. Okay, so we're going to be going over riders. I believe it's the next chapter, but it's in one of the other chapters. Okay, but really quick, I'm going to touch on them and not get too far into it. Going with the increasing term is going to be the return of premium rider and cost of living riders. For right now, that is all you need to know. Later on, when we talk about riders, I will go deeper into what it is, but just know with increasing term comes cost of living and return of premium. All right. Now, really quickly, I don't think that you'll get this on your test, but we're going to go over two words really quick. There's renewable option, right? And convertible. These are going to be in options and provisions, right? Or provisions and options. Renewable just means that you can renew this policy at the time, at the end of its, at the end of the policy, right? When this policy matures, we can then renew. Okay. Convertible is when you are going to go to another type of policy. So renewable is going from term to term. Convertible would be going from like term to whole life. Okay. We would then convert it into a whole life policy and then go from there. Okay. A lot of companies get people that way. They give them a term policy for say 30 years. Then when it's expensive to renew with them, they have to go with whole life because there's not really any other option, monetarily. So you'll be learning a lot about renewable coverages and convertible coverages when you're licensed. All right. Now we have whole life insurance, okay? Whole life insurance is completely different than term, okay? There's a lot of different moving pieces in whole life. There's a lot of different moving pieces in universal life, index universal life. So we're going to take notes on all of this stuff. There's going to be key things for each of these types of insurances, okay? So first of all, term was temporary life insurance or temporary life protection, right? Whole life is permanent life insurance, meaning it's going to go your whole life. It goes from the inception age till age 100 or death. Okay. So permanent life insurance is going to be for the whole life. This is a general term used to refer to various forms of life insurance that build cash value and remain in effect for the entire life of the insured or until age 100. as long as the premium can be paid. Okay. The most common type of permanent life insurance is whole life. You're going to get very familiar with whole life. We replace it all the time. So whole life, like I said, I'm going to try to be objective. Whole life, we're going to learn about the bones of it, okay? But you are going to get quite a few questions on whole life, quite a few questions on universal life. Whole life insurance provides lifetime protection, like I said, until death or age 100. The following characteristics belong to whole life. So one, they say that this is a level premium policy. Okay, we're going to go with that for our test. It is a level premium policy, meaning you will pay that same premium for the duration of the policy, regardless of your cost of insurance. Okay, so level premium policy is what we need to know. Second, there is a death benefit. Okay, so death benefit is guaranteed and also remains level for life. Okay, it's not going to go up, it's not going to go down. Next is cash value. All whole life policies have cash value. All universal life policies, indexed universal life policies, have cash value tied to them. Okay, term has no cash value. Whole life has cash value. Okay, the cash value created by the accumulation of premium, meaning the amount of premiums paid, right, is scheduled to equal the face amount of the policy when the insured reaches age 100. Okay, that's the maturity date, and is paid out to the policy owner. Please remember, the insured and the policy owner do not have to be the same person. Cash values are credited to the policy on a regular basis and have a guaranteed interest rate. Okay. You guys will learn all about whole life when you guys are licensed. So for now, that's what we're going to stick with. The cash value, right, it's scheduled. It's scheduled to equal the face amount. So if you have $300,000 in death benefit, right, as we get older, our cash value should match it at the end of our policy term at age 100. If we live until age 100, that will then be paid out, is what it's saying. Living benefits, okay? Living benefits is what they call borrowing from these policies, okay? So living benefits. The policy owner can borrow against the cash value while the policy is still in effect, okay? Or can receive cash value when the policy is surrendered, meaning canceled. Okay, surrendered means that you gave it up, okay? The cash value, also called non-forfeiture value, right, does not usually accumulate until the third policy year and grows tax deferred. All we need to know for that is that our policy is going to keep the first 3 years of our savings. Okay, it's going to keep the first 3 years of our cash value. And it is going to grow tax deferred, which is kind of a benefit. Everything's great tax deferred. That means we're not going to pay taxes until later. The taxes are deferred. They are pushed out. They are postponed. Okay. Whole life insurance provides lifetime permanent protection, guys. There are 3 basic forms of whole life. There is whole life, right? Straight life, limited pay whole life, and single premium whole life. However, to be honest, really the only one you're gonna see in real life is straight life. Okay, it's just straight whole life. Okay. All right, so this is our whole life policy here, okay? The death benefit is up here on the top. See how it remains level? Okay, it's not going up, it's not going down. Now, here's our premium as well, remains level. Okay, so in whole life, level premium, level death benefit. Our cash value is scheduled or planned to increase over the policy duration of the policy. Okay, so every time we put into our premium, right? Every time we pay into our policy, some portion is going to go to our cash value, ideally. So here it goes. The cash value increases as the policy goes longer and longer until age 100. This is when the policy would end, right? Because we are age 100. At that point, our cash value and our death benefit should be the same amount. At the end of this policy, we are not going to receive both. We only receive one, unless you have an option, which you pay more for, where your family is entitled to both. Okay, so this is just how whole life works. So straight life, also referred to as ordinary life or continuous premium whole life. Please write those down really quick. Straight life, ordinary life, continuous premium life. Okay, whole life. This is the basic whole life policy. Okay, the policy owner pays a premium from the time the policy is issued until the age 100 or death. Okay, they have to pay their policy. Of the common whole life policies, straight life will have the lowest annual premium. Okay, this one is the lowest annual premium. And just know that, because they're going to ask you on your test of which of the three, most common whole life policies has the lowest annual premium. It is going to be straight life. Okay, because there's no extra bells, whistles. Okay. Second, limited payment. Okay, it's exactly what that sounds like. You are only going to pay your premium for a limited amount of time. This is for people who want their policy to last their whole life, right? Until age 100 or death. However, they only want to pay their premiums up until about retirement age. Okay, that's called limited payment, right? Or life paid up at 65, right? You're going to know, or 20 pay life. There's a lot of different names for it. Those are the three names for it: limited pay, 20 pay life, and life paid up at 65. Those are the names. They're all telling you that you're going to only pay for a certain amount of time. But we need to remember that it's not a term policy. This is for whole life coverage. Okay. So unlike straight life, limited pay whole life is designed so that the premiums for coverage will be completely paid up before age 100, right? Because ideally, when we're 100, I don't want to be paying any bills. Some of the more common versions of limited pay whole life is 20 pay life, right? Whereby the coverage is completely paid in 20 years. So from the start, 20 years you will pay, and then the rest of the life you're covered. That would be very expensive, but that's an option. And life paid up at 65. This just means that whenever we start our policy, we are only going to pay until we are age 65. After that point, we will have coverage until age 100 or until death. Okay. All other factors will remain equal. This type of policy has a shorter premium paying period than straight life insurance, so the annual premium will be higher. Obviously, we're going to pay more because we're only paying for a shorter period of time, like we're speeding it up. Limited pay policies are well suited for those insureds who do not want to be paying the premiums beyond a certain point in life. Like I said, it normally ends like around 65, 70 years old. At this point, people are retired. They don't want that bill hanging over them. So they decide to take that shorter option. They pay higher premiums in the front end. That way they don't have to worry about it in the back end. Okay? Next is single premium. Single premium is exactly what it sounds like as well. We are going to pay one big fat lump sum premium to start that policy, right? The cash value will begin growing immediately. Okay, so it will begin to accumulate interest immediately because it's a one huge payment. This you will probably never see in your life. It's for people who have an obscene amount of money just sitting under their mattress, right? Like nobody, or if someone comes up like with an inheritance or something like that and they want to put part of it into a life insurance policy, they can do it this way. So single premium whole life, this is designed to provide a level death benefit, right? The death benefit is going to remain level. It's not going up, not going down to the insureds until death or age 100 for a one-time lump sum payment. Okay. The policy is completely paid up after that one premium and it generates immediate cash value. Okay. Keep in mind, anything with a single premium, whether it's an annuity or life insurance, is going to generate immediate cash value. That money is going to start growing right away. The bigger the sum, the faster it grows. Okay. Right here is just going over the differences between term and whole life. Please go over that on your own. That's a great way to kind of understand what those two types of policies are. All right. We have other types of whole life as well that we will get asked maybe one or two questions about. So we're going to go over those, okay? The first one is going to be modified and graded whole life. Well, those are two separate things. Modified life and graded whole life. I'm going to show you how those work. Very simply, whole life was not attractive to young people for a certain period of time. Okay, here's a little history on it. So the insurance company came up with a type of policy that was more attractive to people starting off in life and a little bit more affordable, but will still get them that whole life protection that they want in the long run. Modified life is a type of whole life policy that charges a lower premium in the first 3 to 5 business years. Not business years. I wanted to say business days, but it's 3 to 5 years. Okay, so 3 to 5 years right here in the beginning, we're going to pay a lower premium. Okay, why? Because this person is just starting out in life. They have high needs, right? Starting families, mortgage, bills, all of that. So lower premium the first 3 to 5 years of the policy. After the first 3 to 5 years, it is then going to shoot up and level out at the appropriate cost. Okay, so think of it as like a gateway whole life policy, right? We're going to get used to paying those premiums. We're going to work our way up to those larger premiums. Okay, so modified life, the biggest thing is that modified life is going to jump. Okay, it's going to go straight up. It's just smaller, 3 to 5 years, boom, regular premium. Okay, just going to shoot right up. All right, the cash value is still going to grow as usual, right? It's still going to grow. The face amount, the death benefit is still going to remain level. It's just the premium that we're going to be talking about here. Okay, so smaller premiums the first 3 to 5 years, then it raises to where it should be, and it's like that for the rest of the policy. Okay, the second one is graded. Okay, the only difference between modified and graded is that it is going to gradually increase until it levels out at that higher premium. So graded premium whole life is somewhat similar to modified life in that the premiums start out relatively low and that they level off at a point higher in the future. Okay, so graded premium whole life typically starts with a premium that's approximately like 50% less than the regular premium that we're supposed to be paying, right? Then it gradually increases each year for a period of 5 to 10 years until it levels out into that higher premium. Okay, so just remember, lower premium, 5 to 10 years it'll raise, and then it'll level out for the rest of the policy, okay, for the duration of the policy. Like I said, modified life and graded premium life policies are a useful or are useful as a compromise between straight life and convertible term insurance, since the premium is less than straight life in the early years, but some cash value is being accumulated. The actual premiums paid over the life of the contract for a modified or a graded premium policy are actually the same as paying for the straight life policy to age 100. So there's really no difference. It's just the way that it's kind of built. Okay, perfect. Alrighty. So I'm actually going to pause here. I think this is a good place to stop. There's going to be a part 2 to this video coming up. If you guys have any questions, please reach out to your upline, to your RVP, and let's get them answered. Everybody should be working on their quizzes. Everybody should be working on their hours while we are doing these tutoring videos. I hope you guys have a wonderful day, and I'll see you on the next tutoring video.